All right, Theta traders. I just want to go over a quick video on Theta decay and how it changes over time depending on what your strike prices are, if you're in the money, at the money, or out of the money. This is a pretty common picture you might see when you're researching Theta decay. And you'll notice that as you go from past 90 days out, it really doesn't make much of a difference if you're in the money, at the money, or out of the money. The lines are pretty much identical. Once you hit around 90 days out, you do start to see a small difference there. Notice the blue line. Notice the blue line was where you're seeing a lot of difference, where you see a much quicker drop from 90 days out. And then when you get near around 30, 40 days or so, it starts to level off. And then you have a pretty consistent theta decay down. If you go for the in the money in red, seems like it's a pretty steady slope from 90 days out to expiration. And then the at the money ones, we usually don't do at the money because there's a good chance there'll be a sign on it. Doesn't decay much at all. But if you were pretty bullish on a stock and you want to sell it pretty close to expiration, the at the monies would decay very quickly because of the gamma risk. So, what are some of the best timelines for plays? I mean, it's up to your interpretation of it. There's not one set way to go on it. What we do at Theta Traders is typically sell between 30 to 45 days out in these longer dated put credit spreads and cash secured puts. And the reason why we're picking around here is you get a good amount of decay, and then we typically try to close it around here where there's not much more decay left into the option. And we want to be going out of the money because ideally we don't want to get assigned, and we want to take those premiums, essentially buy them back at a lower price that you sold them at. If you're deciding to go closer to the at the monies, not necessarily the best idea to go 45, 30 days out. It is a pretty good decay, but not as a steep curve as you're going a week or two out before expiration. I think it's a pretty risky play to go a little bit close to at the money with a week left. What we're trying to do in our covered strangles with MES is essentially take advantage of this green line here, because at the money it's a very steep slope, so that decay is happening very quickly. If you'll look at an MES covered strangle that we're doing, if you look at Thursday or Friday right before expiration, those decay really quickly. So again, I'm trying to take advantage of both situations. It's up to you and your risk tolerance. Maybe you could do a little bit more of the blue type out of the money ones. You could do a little bit more at the monies at lower time frames. Hopefully that answered your question, and feel free to ask any more on the Discord.